Welcome back, focused learners, to this explainer. Today, we're completely flipping the script on how you approach the markets. Forget the whole day trading is a lottery ticket or get-rich-quick myth. We're tossing that right out the window. Instead, we're going to frame this journey exactly as it should be, as a systematic, calculated preparation for battle, using cold, hard math and probabilities. When you strip away all that social media noise and hype, trading really just boils down to observing data, managing your risk, and letting those numbers play out in your favor over time.
Okay, let's dive into this. The truth is, it is entirely possible to waste years of your 20s and thousands of dollars that you really didn't need to spend. Honestly, without a structured approach, you're just flying blind out there. But by consolidating this learning path into a strict system, you can totally bypass those wasted years and all those lost dollars. You don't need to overcomplicate the whole shebang. You just need the right foundational information from day one.
To make sure we cover everything, we're breaking this down into 5 logical phases for you today. Phase 1, the reality of day trading. Phase 2, the psychology of trading. Phase 3, the math of profitability. Phase 4, reading the market charts. And finally, Phase 5, building and testing strategies.
All right, starting right off with Phase 1, the reality of day trading.
We need to ground our expectations right out of the gate here and understand what the market actually represents on a practical, day-to-day level. Think about it. If you invest $100 in the S&P 500 and wait an entire year for a fantastic 26% return, you've made, well, $26. Now, that's absolutely fantastic for long-term wealth building, but it requires massive capital to actually generate a livable daily income. Day trading, though, it's a completely different beast. By zooming way in from a weekly chart down to a 1-minute chart, day traders find multiple opportunities every single session. In this fast-paced environment, you can risk that exact same $100 with a calculated stop loss and have the potential to make 5 times that amount in just a matter of minutes or hours by spotting asymmetrical risk-to-reward setups. It's really all about frequency and leverage, not just sitting around waiting for annual growth.
To actually execute these daily trades, you're going to need your arsenal. There are 3 absolute, non-negotiable, mandatory tools. First up, TradingView to access what they call super charts. This is your home base where you'll do literally all of your visual analysis. Second, a broker or exchange to actually execute those trades. You've got options like Blowfin or Bybit for crypto, and platforms like Tradeify or TopStep for stock traders who are looking for funded capital. And third, and I'd argue this is the most important piece of the puzzle, a comprehensive trade journal to rigorously document and analyze every single move you make.
Moving right along to Phase 2, the psychology of trading.
Now consider this a fair warning. What we're about to talk about requires an entire mental rewire that most retail traders, sadly, never figure out, which is exactly why so many fail. You see, human nature dictates that losing money or being wrong means you made a mistake, that something needs to be fixed right away. But trader nature, it demands the exact opposite perspective. The market is somewhat random. You can do literally everything right and still hit your stop loss. Therefore, calculated losses are not failures at all. They're just a pre-built business opportunity cost. Think of every loss as just an expected, totally normal expense required to keep your trading business running so you can capture those big wins.
This right here is a massive, incredibly counterintuitive reality check. In trading, you get paid to be profitable. You don't get paid to be right. Seriously, if you have an ego that demands you perfectly predict the future every single time, the market will crush you without a second thought. You have to completely strip away the emotional ego of needing to be right on every single trade. Your one and only job is to be profitable over a long series of trades, not to be a fortune teller on one isolated event.
Let's transition into Phase 3, the math of profitability.
So, by using strict position sizing based on simple middle school math, we can remove all that pesky human emotion directly from the charts. Which brings us to the most crucial paradigm shift of this entire explainer. Are you ready for this? How is it mathematically possible to be completely wrong on 70% of your trades and still walk away with actual money in your pocket? And this brilliantly illustrates exactly how the math protects you. In trading, we use R as our standard unit of risk. Let's say you risk $100 per trade. That right there is 1 R. If you lose 7 trades, you're down 7 R or $700. Ouch, right? But wait. Because you only take trades with high asymmetrical reward potential, let's say your 3 winning trades yield 5.2 R, 2 R, and 3.1 R. That's 10.8 R in total gains. Subtract your 7 R in losses and you are left with a net positive of 3.8 R. You were wrong a whopping 70% of the time.
yet you still walked away with $380 of pure profit. The math literally protects you when your ego takes a hit.
All right, on to Phase 4, reading the market charts.
Now that your mind and your math are securely in place, let's equip you with your technical analysis weapons. First up, the trusty candlestick. These are not just random magic lines drawn on a screen, okay? A candlestick is a literal visual footprint of mass human psychology. A red candle, that just means sellers, overpowered buyers, driving the closing price below the open. A green candle means demand outweighed supply. By looking at the open, close, and the high and low wicks over any given time frame, whether it's a 1-minute or 15-minute chart, you're actually watching a real-time tug-of-war for equilibrium between buyers and sellers.
Zooming out just a bit, we want to look for market structure. Simply put, this is the dominant direction that the price is heading. An uptrend is confirmed by a clear series of higher highs and higher lows, which are validated by what we call breaks of structure. That's when the price pushes aggressively past a previous high. Establishing this market structure is absolutely vital because it allows us to align our trades with the dominant market direction. You never, ever want to fight the trend. You want to ride it.
So the crucial point here is knowing exactly when that trend is ending. Enter the change of character. This is the precise moment when the price fails to hold its established structural levels, like, for example, breaking down below a previous higher low instead of making a new high. Identifying this specific, subtle shift acts as a trader's early warning system. It pinpoints high-probability reversal entries mid-trend, allowing you to position yourself right as the momentum shifts. It's a real game changer.
61.8. Now, this isn't just some random decimal we pulled out of thin air, it's the golden ratio of the Fibonacci sequence. This is a naturally occurring mathematical ratio found in seashells, tree branches, human facial symmetry, and fascinatingly enough, in the tendencies of mass human psychology. When a market trend pulls back, the price frequently bounces right off this exact 61.8% retracement level. It is a naturally occurring phenomenon where buyers or sellers historically tend to step back in.
And we can actually layer that with something called a fair value gap. This is a very specific 3-candle sequence where the wicks of the first and third candles do not overlap at all. This leaves a gap, a stark visual area of intense supply or demand imbalance. Because the market always seeks equilibrium, price frequently pulls back directly into this gap to fill it. So think about this. If you can find a change of character and wait for a pullback into a fair value gap that perfectly aligns with that 61.8 Fibonacci golden ratio, wow, you have just found a hyper-accurate, incredibly high conviction entry zone to place your trade.
Which leads us perfectly into Phase 5, building and testing strategies.
Okay, a massive warning right here. Skipping this step and rushing straight to live markets practically guarantees failure. Don't do it. You absolutely must follow this exact progression, from theory to live execution. First, observe the charts and find a concept, like our fair value gap and Fibonacci overlap we just talked about. Second, define exact, unbreakable rules for your entry and your risk. Third, use the bar replay tool in TradingView to literally rewind time and backtest your rules against historical data, logging every theoretical win and loss right into your journal. Fourth, paper trade your system on a live exchange using simulated capital. Only after you've completely mastered those 4 steps do you move to step 5, executing with live capital. True, unshakable confidence comes only from this rigorous, simulated practice.
And you absolutely must take advantage of this fact. Trading is arguably the only business on earth where you can achieve full proof of concept without spending a single dime of your own money. You can test your strategy, figure out your exact win rate, and calculate your average risk-to-reward ratio, all in a risk-free simulation. Your trade journal and backtesting tools are absolute non-negotiable requirements before risking real, hard-earned capital.
Which leaves us with this final burning question. Are you ready to stop blindly guessing the market's direction and finally start treating your trades like a calculated, emotionless mathematical equation? The tools, the math, and the structural blueprints are literally all right there on the charts, just waiting for you. Your next step isn't to open a brokerage account and gamble your savings. It's to open TradingView, turn on that bar replay, and start testing your edge. Happy charting, focused learners, and I'll catch you in the next explainer.